Global Market Perspective with Darius Kowalczyk, Senior Economist and Strategist, Asia ex-Japan Credit Agricole CIB. Darius, hi. Thanks for taking time out. First, with the state elections out of the way in India, what is the expectation from the budget? Because there's growing opinion that the budget is going to be a populist one this time around in India.
I think that indeed the elections suggest that the Congress party will need to focus on regaining popularity and coming up with a budget that could be pretty populist. So we expect that the fiscal deficit may be high and disappointing to markets, and spending plans may be quite aggressive, which would not be good either for Indian bonds or for the rupee.
Okay, so you expect the budget to be populist. What could that potentially do to foreign investors watching the market closely?
It would make them nervous because fiscal deficit is running above targets and is one of the two key imbalances that worry foreign investors, the other being current account deficit. Such a big twin gap makes the economy less balanced, and investors will be concerned that their investments may not be as safe as they had hoped, and that the central bank cannot cut rates enough to stimulate the economy because they have to worry about inflationary impact of large budget deficit. And again, this would slow direct investments and definitely portfolio investments.
So Darius, what according to you is a bigger risk for India in the near to medium term? A poor balance sheet and lack of reforms, or the politics where the government is losing its ground?
I think that the key risk is lack of reforms and lack of more favorable environment for investments, because it's investments that have slowed Indian growth the most recently. And it's investments that are needed for long-term, sustainable, fast expansion, especially infrastructure investments. If they are not coming in fast enough, then India will not achieve the kind of long-term growth that it wants to, and inflation bottleneck will rise due to infrastructure bottlenecks, or at least will not fall as much as we want. So definitely, lack of reforms and infrastructure investments is a key issue.
There is a quick call on the currency market as well, because the rupee is back above 50 to the dollar. Is there a feeling that we'll see rapid withdrawal of money in light of the uncertainty in the run-up to the budget?
I wouldn't say that we will see a rapid withdrawal of money, because we are in a good environment globally, given the favorable news from the Greek bond swap. And this will shelter all emerging markets, including India. So what I expect is either small decline of the rupee as investors do pull out a little bit of money. It will be bigger if the Greek situation was worse, or if all emerging market assets rally sharply, then the rupee would lag.
So Darius, do you believe then that the global risk today has receded from the start of the year, with the situation in Europe as well as US now stabilizing?
I think that definitely the first 2.5 months of the year have been positive and better than expected, because systemic risk coming from Europe is being reduced very sharply, as it seems that the Greek issue has been pushed down by a few years, so we have a few years of relative calm, and huge liquidity infusion by the ECB via long-term refinancing operation will allow government debt from peripheral Eurozone countries to go up in price and down in yield. So this reduces the systemic risk for Europe and allows investors elsewhere to focus on fundamentals in attractive areas, in particular emerging markets.